Are you ready? We got 5 sub $1 microcaps with game-changing catalysts through 2025. From Algerian fracturing contracts to China smart logistics and AI security warrants. Now these names could skyrocket when you least expect them. Stay tuned to the end of the video. Welcome back to StockScope Live. I'm your host Ali, and this channel we give you actionable stock ideas. Today we spotlight 5 different companies. New Century Logistics, 9 Energy Service, Shengfeng Development, iPower, and Skycorp. We'll break down their business models, recent financials, technical support resistances, key catalysts, and risk controls. Let's get right into it. Let's start with New Century Logistics. This is a very interesting one that I've just recently learned about. They're a Hong Kong registered freight forwarder. Basically, they provide air and ocean export-import services. They do custom brokerage, bonded warehousing, and they do inland transportation. Then they tackle the last mile delivery solutions. It targets small to medium enterprises that are importing, exporting consumer goods basically across Greater China and Southeast Asia, and now they might be moving into Europe. The financials are okay. They have a revenue of about 48.3 million, but they posted a net loss of 2.17 million. And their average daily trading volume is approximately 38,000 shares, and their market cap is sitting about 13.44 million. So a very small company. Now they do have a strong balance sheet of about 5 million in cash, but they do have 12 million in debt, and it's very manageable net leverage of around 1.4. The technical analysis is, let me switch to TradingView. As you can see, they're currently trading around 63 cents per share. And this is near the multi-month lows. The 52-week range is between 46 cents and $4.15. They have support levels around 60 cents, and the resistances are around near 75 cents. Now, the key catalyst and the reason why this got flagged on my list is they're doing a strategic partnership pilot with Silkway Airlines to deliver time-sensitive cargo between Europe and Asia. And as we all know, with the trade war between America and China, more exports are going from China to Europe. They also launch an in-vehicle drone logistics pilot in Hong Kong, targeting the urban last mile challenges that most companies also struggle with. Now, some of the principal risks, and we wouldn't be doing you any services if we don't talk about the risks. The Hong Kong real estate and warehousing costs remain elevated, and that pressures margins. Plus, potential slowdown in China's export volumes amid global trade headwinds. But I don't personally see that as a problem, given that China can export to many other countries in Southeast Asia, regardless if they're trading with the United States or not. Now, my recommendations is initiate a speculative position near 60 cents. Use a stop loss around 55 cents. And monitor quarterly volume trends for signs of renewed freight demand and margin pickup. And if you see it bumping back up, that's when you can get back in. But just so you know, like back in May, they were at $2. So this stock has a lot of upward potential if these new pilot projects come online. And I think that this strategic partnership to deliver cargo to Europe is going to be a big driver of revenue. Coming in at number 2 is 9 Energy Service Incorporated. They're a Houston headquartered oil field services company, and they're focused on the North American unconventional wells. Its offerings include completion tools, cementing, wireline, and coil tubing services. They're tailored to shale plays such as Haynesville, Permian, and Eagle Ford. They were founded in 2011, and they differentiate via high specification fracturing fleets and digital completion technologies, which is a key factor in their competitiveness. Now, if we look at their financial profile, in 2024, their revenue declined 9.1% to 544 million due to basically lower basin activity. Now, their net loss widened to about 41.1 million, and then in their EPS, earnings per share, they were at negative 1.1. And in Q2 2025, it went up to negative 0.25, which obviously is much better. And this is driven by higher maintenance capex. Their market cap is around 27.5 million, making it a microcap with limited catalyst coverage. Let's switch over to the technical analysis. And here it gets a little interesting because currently they're trading around 64 cents. They have a very strong support around 60 cents, and we've seen it bounce back off of those areas multiple times. If we can get to about 75 cents in the next few weeks, and we see the 200-day moving average come towards that 75 cents, we're going to see a squeeze to the upside. Now, obviously, this is a very low trade capacity, and you can see like the average daily trade is maybe 300K, 400K. Still decent enough that you have liquidity. The catalyst that we're looking for here is asset concentration in the Haynesville play. This aligns with rising natural gas demand and winter heating season catalysts. Their ongoing debt refinancing expected in late this year, potentially extending maturities and alleviating near-term liquidity concerns. Let's talk about the risks. High leverage, modest liquidity, and if they don't get refinancing, that might be an issue. Their capital spending cycles remain unpredictable, especially if there's a gas oversupply scenario. Also, there's a sharp bid-to-ask spread, and this can make it tricky for entry and exit orders. Recommendation, consider small, speculative entry between 60 and 63 cents. And your stop loss set very close, between 55 and 58, depending on your entry point. You should monitor their monthly rig count and also storage draw data, and that should give you a good gauge on the demand for completion services. The next ones take us back overseas to Shengfeng Developments in China. They are an operation for freight logistics, cloud storage, and supply chain management platforms. They were established around 2001, so they've been around for a minute. And the company provides contract logistics, custom brokerages, last mile delivery, and digital warehousing solutions. It recently forged partnerships with major battery maker CATL, and they provide specialized material handling for them. So the financial profile, let's look at 2024. They did 540 million with a net income of about 11.7. The first half of 2025, their income or their revenue rose 16%. And obviously this had something to do with their contract with CATL. They have a PE normalized around 9.2, which is not too bad. And their valuations appear undemanding, but it also hinges on China's broader macroeconomics. Let's switch to the technical side. Their shares currently trade around $1, and they're on the NASDAQ. They saw a sharp decline from September to right around today of about 16%. Now, this is not too big of a deal. We know that the retreatment indicates support at 97 cents, and they have resistance near $1.05. They have low average daily volume of around 20,000 shares, and if you average it out between all the days, that's what the average is. And this can amplify volatility on news. Let's talk about the catalysts. They have a scaling of smart logistics center in Nejd. I don't know how to specifically say that. They're leveraging warehouse automation and IoT tracking. They also have potential cross-selling of cloud storage services to logistic clients as digital transformation accelerates. The risks, as always, China economic deceleration or any COVID breakouts or anything like that could dent their freight volumes. Their margin pressures from rising labor and real estate costs, particularly in the eastern seaboard provinces. Now, regulatory changes in cross-border trade and customs could increase compliance costs, but that's on every logistics company. Our recommendation is adopt a long stance if the price sustains above $1. This should come in reflection of renewed institutional interests. Aggressively pivot to cash if shares breach 95 cents. Now, because the volume is low, you need to be very careful. As you can see, in some days, they've had high volumes. The next one is actually very simple. iPower Incorporated. It's a microcap e-commerce retailer and manufacturer. They make a bunch of different things like grow lights, HVAC systems, pumps, filters, you name it, gardening stuff, and other stuff that consumer electronics that they have. Now, they also include a bunch of different brands like Zen Hydro, Flourish, and iFarm, and I think they have it here on, yes, right there. So they come under Scratch Me, Fluffy Dream, and all those stuff. They also sell their stuff all over the internet, Amazon, Walmart, eBay, Wayfair, you name it, they got it. Their financial profile is actually not too bad, but it's looking like it's improving, and that's why it showed up on my radar. So their revenue last year in 2024 was around 86 million. It was down 3.2% year over year, but they were doing a bunch of transitions and inventory optimizations, which should actually come into play in the next couple of years. They obviously posted a net loss of about 1.53 million, but to show you how they're improving, that 1.53 million is actually an 87% improvement year over year. And that's driven by cost controls and shipping cost pass-throughs. They have a very high gross margin of about 45.6%. And operating margin right now is a negative 1.1%, which gives them a net margin of negative 1.8%. Their EBITDA is slightly negative currently at negative 0.2%. But again, it's improving. So they have cash and equivalents of around 60 million, and their total debt is around 150 million. Primarily in convertible notes and leases, then that's basically very normal. So their debt to equity ratio is around 39.6 on a microcap base. The current ratio of 1.92, their free cash around 0.51 million and 0.7% of revenue. Technical side of this, let me switch to trading view. They're currently trading around 56 cents. They had a bit of a downturn, and then they rebounded from around 49 cents. And if we zoom in a little bit more, we can see they've had these microcaps always have this massive squiggly line. But they have decent volume. Like on this day here, back in September 22nd, they had 46.95 million shares traded. On recent days, they're sitting around the 130 to 150 shares traded. So decent volume going through there. The resistance sits around 0.6 to 0.92. So and the monthly MACD shows a positive crossover right now. So we think that this is going to actually go up. Their key catalyst is their Q4 growth driven by their indoor cultivation cycles. And they are doing stronger revenues quarter over quarter. Their nut product rollout in environmental monitoring, that's like temperature and humidity sensors, and upgraded climate control suites are coming up. They're also continuing expansion into third-party retail channels and into international distribution partnerships. And I think we saw something about that in here when they were talking about their partners. Let me just go back there right here. Xyla is an international company. So this should give them more exposure globally. Now, as always, we need to mention the risks. They have high leverage, heightened interest rates, and financial and refinancing risks, obviously, if the margins compress. But as we know, the Fed is going to be cutting rates, so this should actually be helpful for them. The freight cost volatility and semiconductor shortages could squeeze the gross margin. And potential dilution from upcoming note conversions or equity raises to fund growth or to repay debt. That could be a factor. Our recommendation is to add or establish a position on the daily pullbacks towards the 54 cents and employ a stop loss, a very sharp one around 50 cents. Consider like trimming any gains if it breaks above 62 cents and then reevaluate after the quarter results that are coming up. And I believe that is very soon, November 12th. So make sure that you're always reevaluating after the earnings. Now, their last earnings, if we look at, they missed by a bit, 30%. And their earnings per share was missed by a bunch. But before that, they posted 19 million, and before that they were very close, only missed by 10%. Here they missed by 10%. So it's been pretty consistent around 20 million so far. I think that there's a squeeze coming here at some point around the 60 cents, and then we're going to see a move in either direction. But as you can see in the MACD at the bottom here, we're seeing a nice crossover, which indicates upwards momentum. The next one is Skycorp Solar Group. And these guys, you've guessed it, they focus on solar stuff. Solar cables, connectors, hybrid inverters, energy management systems, the works. They also invest in small-scale solar farms and acquisitions. They also offer blockchain-based payment solutions for solar energy off-takers. Now, they just got listed on the NASDAQ March this year. So they had revenue last year in 2024 about 50 million. Net income was around 0.5 million. And right now they're focused on R&D and the expansion of their product lines. They do have nice cash reserves, about 8 million. Their debt is around 5 million, so very good net cash position. Currently, they're around 69 cents. They've been consolidating between 64 and 76 cents for the past few months. They got support around 64 cents. And because they were just recently listed, obviously their 52-week highs is like around $4.50. Now, the catalysts, crypto payment integration platform. They're going to launch this for direct P2P solar energy settlements. And they're targeting rural areas and microgrids. They also did an acquisition of 2 small solar plants in the Guangdong province. This added 5 megawatts of capacity. Now, the risks. Solar installations are typically tied to, you guessed it, government subsidy schedules. And high valuation multiples with these small companies makes them sensitive to growth misses. So consider that. Let's bring up a trading view on this one just to give you a quick idea. They started up here around $4. They topped around 4.10 or even more depending on which currency, Canadian or USD. But right now we're just going to look at the month data. And as you can see, since around September 22nd, they've been consolidating in this line area. So we're getting closer to a squeeze. We're getting very close to a squeeze. And I think we can probably get something in here above 70 cents. Now, why above 70? We need a clear breakout above 70 cents. If it's not a clear breakout, I'm not touching it. I need to know this is moving up. I'd rather not be at the lowest price and make sure that it's moving up. I would set a stop loss at 0.6 to guard against any reversions. So this one is pure speculative micro position. If we look at the daily, let's look at the daily trading volume. Decent volumes, 150, 260, 40, 50, 120. Not too bad in terms of liquidity. So I would think that as the 200-day moving average starts to come down, maybe closer to mid-November, this could be a play. So just set an alert. Make sure you watch it. If you found the IDs I provided valuable, hit like on the video, subscribe to the channel. We're going to drop at least 4 more of these videos over the next 4 weeks. And comment below with the favorite ticker and why. I'd love to hear your thoughts. If there are tickers you want me to cover, also drop those in the comments. Thanks for watching. And remember, stay safe, stay diversified, and I'll catch you in the next video.